Right. Good. Right. Good morning. My name is Asanka Liyanage. I am doing the ratio analysis part of your credit management diploma course. Before starting the lecture, I want to give some introduction about myself. I'm a qualified chartered accountant with a first class from Javaratnam University, an MBA from PIM, and a qualified banker, and other CMA certification as a certified management accountant. Right. Normally, I'm doing lectures for business accounting for banking exams. This model is a compulsory session, and you have to get an average mark for this section as well. There are two sections, one from the ratio analysis, other balance part, or also there should be an average mark for you to obtain to get through from the exam. The sessions will be like today. I started the session at 8:30 and goes till 12:30. But next week onward, I will give the same message before the end of the session also. Next week onwards, I will start the session at 7 a.m. and goes till 10:30. Right. If I go to the syllabus and the things that I am going to cover, to take the credit management diploma, you have to calculate, analyze, and interpret the financial statements of a given entity like proprietorship, partnership, company, different nature of entities. If you take a company also, you have hotel industry, you have tourism, you have different kind of industries. For each of these industries, they prepare the financial statements. In this course, you have to learn and understand how to analyze this financial statement and give some interpretation about the financial statements. Now, if you take a credit decision will be taken based on mainly two factors. One is the particular borrower's creditworthiness will be evaluated. In simple terms, the repayment capacity of that particular borrower you have to evaluate. Then the second important point is the collateral or the security that he is going to pledge with us. Those are the two critical points. In these particular sections, we are going to study the analysis of repayment capacity or the credit worthiness of a particular customer or an entity. I know for sure that you have some average understanding about the financial statements and the accounting and the related aspects of the accounting techniques. But here, normally what I do is I assume that you all are having zero knowledge in accounting. As far as accounting is concerned, you don't have any knowledge in terms of accounting. Assuming that I start from the zero for you to get an understanding about the accounting and the financial statement analysis. In order to do that, I normally in this is I suppose fourth or fifth year I am doing this session. Every time I come across even though the people are there as high rankers, they still find it difficult to analyze the financial statement if you ask a very simple question. At the beginning, if I ask what is the biggest asset in the bank financial statements, you may have different answers. If you go to balance sheet, or the new name is a statement of financial position, what is the biggest asset in your bank's financial statement? You may have different answers. Unfortunately, I asked the same question when I was conducting about 1.5 years back. I was conducting a training program to a senior set of people who are going to retire in 1 or 2 years time, and I asked the same questions, right? There were government and private banks, AGMs, senior managers, chief managers, different caliber of people who are nearing their retirement. Before starting the session, I asked this simple question: what is the biggest asset, the largest asset in your balance sheets, respective banks balance sheet? Then there were different answers. Some said deposit, some said it is the employees, right? Some said cash and cash equivalent, some said investment, some said loans and advances, right? You also may have different answers, right? I know for sure. That is the level of accounting knowledge we have. Even though we are senior bankers, when it's come to accounting, the financial statements, you may have different answers for a question, but there is one answer. The correct answer is the loans and advances. If you take the loans and advances, that represent at least 80 to 90% of your bank assets, right? You may have different answers in your mind, but the correct answer is loans and advances, right? Now, if we come back to the session, that's why I am starting the session from the zero level, assuming that you don't have any accounting knowledge. By spending this first session, today's session, on this basic concept of accounting, it will help for you to analyze the financial statement in a given entity. In order to analyze the financial statements of a given entity, you need to know the basic concept of accounting. If you don't know the basic concept of accounting, it will be very difficult for you to analyze and interpret the financial statements of a given entity, right? If you take the definition of accounting, now the lecture is going like, if you do have any questions, you can disturb me and ask that question, right? If you want to ask any question, you can disturb me and ask that question, right? Make sure that your mics are off after you ask the questions, because otherwise all the people get to know the unwanted things from your home or where you logged in, and everyone will get to know about those things. Therefore, as senior people, you have to mute your mic, right? But anyway, if you have any question, you can disturb me and ask that questions, right? If you take the definition of accounting, accounting in the definition itself says in business organization there are many transactions happening, right? If you take a transaction, if you take a bank, transaction is when a customer makes a deposit, that is a transaction. When a customer makes a withdrawal, that is a transaction. If you grant a loan, that is a transaction. If you open LC, that is a transaction, right? If you charge some bank charges from a customer, that is a transactions. If a customer withdraw some money from the ATM, that is a transaction. If a customer pays his grocery items via a credit card, that is a transactions. In accounting, it defines when there are transaction, there should be a system for you to collect those transactions and to record those transactions. Then classify those transactions. After classifying, it should summarize those transactions. Then analyze the transactions. After analyzing, interpret the transactions, interpret the results, thereafter distribute or disburse among interest parties who take economic decision on that entity. Therefore, if you take the account definition of accounting, there should be a kind of a process or a system while that process or the system is operating. It should collect, then record, classify, summarize, analyze, interpret, and distribute the results among the interest parties. The whole process is called accounting. Now, if we take a simple example in your bank, when a customer makes a deposit, say over the counter, he comes and deposit the money. Then your teller takes the money and take the deposit slip and count it and put the entry in the core banking system. Then someone verify that. That is how the transaction is collected, right? Transaction is, there is a process of collecting the transaction, then it has been recorded. When that person records the transaction, he classify the transactions. If it is a current account, there is a specific code given to that current account. Therefore, while recording, he is classifying also. Then after few months, after say end of the month, all the total of the current accounts, including that particular current accounts, the total money collected, we can summarize, right? To take that particular current account, we can summarize that thing. Then we can analyze, right? If you take like those current accounts, we can, at the end of the month, we can analyze and say our current accounts total is increase or decrease compared to the previous month end. Then once you analyze, you can interpret. If it is decrease, what has happened? If it is increase, what has happened? Now, if you take these days, the CASA base increasing because the fixed deposit interest rates are very low. Therefore, people didn't want to have that much of interest sensitive scenario these days. Therefore, they don't matter whether that their money is in current account, savings account or fixed deposit account, right? But if it is a interest high scenario, the people will withdraw from the CASA base and put that money into the fixed deposit, right? There, likewise, you have to interpret, right? Thereafter, you have to distribute among the decision makers, right? Those details, if the current accounts of a given bank is increase or decrease, that information should go to the managing director, corporate management, maybe board, right? To take decisions. If it is increasing, if it is decreasing, you have to take the corrective actions, right? Therefore, the accounting is the process where all these facilities are provided. If there is no accounting, you cannot do business, right? Even for a small entity, right? Like a grocery, there should be some accounting. If there is no accounting, the business cannot survive. The business cannot survive because they don't have information to take decision, right? Therefore, it is a compulsory requirement for you to have some kind of accounting technique within your organization to make some records out of the business transaction. There should be a collection process to collect the transaction, record the transaction, classify, summarize, analyze, interpret, and distribute the results. Accounting, the subject of accounting facilitate all these functions, right? Therefore, in business, in normal business industry, the accounting is called language of business, and the people who are practicing the accounting are called accountant. The language of business here, if you take the accounting or the financials, the final results of accounting is the financial statements, the final accounts. The financial statement of an entity in Sri Lanka can be reviewed, can be read, can be interpreted by a person in America, a person in UK, a person in Italy, a person in Middle East. The same way, the financial statement of an entity in USA can be interpreted, can be read, can be analyzed, can be anything we can do here in Sri Lanka. Because the same way in all around the world, we are doing the accounting. There are minor changes as far as the accounting is concerned. If you take country to country, there are few minor changes are happening, right? Because all the accountant in all around the world are doing accounting based on the accounting standards. There are set of standards you have to follow, right? And that is a basic definition of an accounting. Then we'll go to the next thing. This is a very summarized version of what we have discussed earlier slide. Identify the business activities, then record the business activities, then finally you have to communicate the business activities, right? This is what accounting provides to the business. Then if you take the users of accounting, external users and internal users, uh, in a business organization, normal business organization, not a bank, normal business organization, if you take a normal grocery or a normal entity, the external users will be the lenders. Lenders means the banks and other financial institutes, right? Then shareholders, government are worried about this accounting because they need to collect their respective taxes. Then external auditors, customers also worried about. If you take a bank, all the customers are worried about the financial statements of that bank, right? That's why there is a specific requirement by central bank to publish the respective financial statements of banks in where places where the banks are doing business. If you go to a branch, you have to publish your bank's financial statement, latest financial statements, right? Then if you take the internal users, the managers, officers, internal auditors, sales staff, budget officers, controls, they are also using the accounting, right? Then role of accounting, we have to, in business organization, we have to, in the profit motive uh, thing, therefore business are for profit maximization purpose. Therefore in order to know the profit, the accounting plays that role also, and keep track on the return on investments, right? All these information are provided by the accounting. Keep track on profit or loss of that entity, whether we have profit or loss, that is also provided by the accounting. Then keep track on asset, liability, equity of the entity, right? Then keep records of income and expenses. This is the role of accounting, right? If you take accounting as a system or a process, right? Normally in any process, there are three things. In any process, there are three things, that is input, then process, actual process, then output. Similarly, in accounting also, we can take accounting as a system also. There also we have that three things: input, process, and output. What is the main input of accounting? That is transactions. Transaction occurred in a business organization. That is the main input. Then the process is, I already discussed in the definition, we have to collect, record, classify, summarize, analyze, interpret, and distribute. That is the process. Then the output, the main output of accounting is the financial statements. The main output of accounting is financial statements. The financial statement comprise of, if you go to the definition of financial statement, it comprises of 6 main items. IS means income statement. IS means income statement. SOFE means statement of financial position. Statement of financial position. Then CFS means cash flow statement. Cash flow statement. Then SOCIE means statement of changes in equity. Statement of changes in equity. Then APN means accounting policies and notes. Accounting policies and notes. Those are two separate things. Accounting policies is a separate one and accounting notes is a separate one. The main output is the financial statement. The main output is the financial statement. Then the second output is the management report. There are various reports requested by management, including the board of directors, corporate management. They request various reports, right? Then third one is other reports. Apart from the management, there are other reports that the accounting process is preparing. Then if you take accounting, this is the process. The input is the transactions. Then the actual process is collecting, recording, classifying, summarizing, analyzing, interpreting, and distributing. Then the finally outputs are, the main output is the financial statement. It includes 6 parts. Then management reports, other reports. Again, we are discussing the interested parties for a financial statement or interested parties of a business. First one is the owners. Definitely, owners are interested in the financial statement because they want to know the profit or loss of the entity, whether the company is in a liquid position, whether the company in a bankrupt position, solvent or insolvent, right? At the end of the year, whatever the things that they have done, the owners, they have put money, they have put effort, everything is there. What is the final results? Those things they need to know. That's why they are worried about the financial statements. Then if you take the management team, like you people, maybe branch managers, maybe credit officers, maybe senior position people, they also worried about the financial statement. They worried about the financial statement for 2 things: to plan their future or plan their budgets or everything, and to see the actual results also. Whether our strategies are working or not. Then the prospective owners, right? If you take these days, the people are very interested in the share market. When you want to buy some shares of a different entity, the only source of information that you could go through is the set of financial statements of that particular entity, right? Therefore, prospective owners, before making an investment, they want to know the financial results of that particular entity. Then lenders and creditors, like banks, financial institutes, before making a credit disbursement, they want to know the repayment capacity of that particular entity. Therefore, they need to analyze the financial statements of that particular entity. That's why we are also doing this particular course also, right? How do we analyze the financial statements? Then customers, especially the customers of a bank, right? And other institute also, customers may be worried about the financial statement of particular entity, because they want to deal with an organization where their financial results are good, right? Therefore, customers also worried about the financial statements of a entity. Then government agencies, especially the Inland Revenue Department, they also worried about the financial statement in order to collect their taxes. Then employees and union leaders, why they worried about the financial statement? If you take the employees, they want to have a job security thing. Because if an entity is making losses, that particular entity's employees won't be happy, because their security of that their job is in doubt. Therefore, in order to get a better understanding of their job security role, employees are also worried about the financial statement. The union leader also, they want to get higher salary increment, higher benefits. That's why they are also worried about the financial results. Especially these days, in your banks, the financial results are yet to be announced. There is a deadline. Before 20th of February, they want to release the financial results. Now, especially these days, there will be audit committees to release the financial results of banks. Then various analysis, right? In order to make various research people, they take the financial statements. Then there are three categories of accounting: financial accounting, management accounting, and cost accounting. I won't go into detail. Basic difference is, if you take the financial accounting, it always talks about the past, what has happened, right? Not about the future. Always talk about the financial results of the past. That is financial accounting. But if you take the management and cost accounting, it talks about the future and the present. Especially if you take the budgets, those are comes under management accounting. Cost accounting, that is where you analyze the results and costing of products and processes. That is under the cost accounting. We are not going to deal in detail in these areas. If you are interested, you can get an understanding about those things. But make sure the important point here is financial accounting we are worried about. Financial accounting, we only talks about the history, not about the future. Right. This is the area where your attention needs to be there in today's lecture. You can see the heading, double entry system. People, even the people that even they are nearing their retirement, they still find it very difficult to understand this system called double entry system, because they learn in differently when it comes to this double entry system. But make sure today's you learn it very correctly, right? Make sure that you learn it very correctly. Very simple thing. I hope that my efforts will be validated by you when it comes to the exam. Exam also, make sure that since this is an online session, last time also we had this online session, and the passing rate of the credit management students, it was like 50-50. Normally we have a passing rate of 80% to 90% when it comes to physical conducting of lectures. But last time we had this online session first time, and we had that exams, and marking had been done and finalized. I got to know today it was like 50-50, because there was a change also. You have two papers, one from the statement of analysis of financial statement, that is one part of the paper, and the other part is all the other things will be included in the other part of that second paper. You have to get an average mark to get through the exam. Therefore, both sides are important. If you are good at financial statement analysis, that is also not a good thing to pass the exam, but you have to have good understanding of the other sections of the course. Similarly, if you do have good understanding about the other sections, if you don't mind of this analysis of financial statement, that is also not good to get through the exam, right? Therefore, the average understanding and the average mark you have to get to pass the exam, right? If you take this double entry system, that is the important point or important session of accounting. Uh, if I if I identify accounting as a human body, right? The heart of that human body is the double entry system. If we identify accounting as a human body, the heart of that human body is the double entry system, right? Therefore, that is of utmost important topic as far as accounting is concerned. If you go to the topic, it says, if I define, in accounting, you take transaction, you take the value of the transaction and you debit that value to one account. Similarly, you credit that value to another account, right? Then after some time, the debit totals and the credit totals will get tally. That is called double entry system. This was introduced by a famous Italian called Luca Pacioli. If Luca Pacioli was not there in the past, today we don't have this session. Thanks to Luca Pacioli, we are having this session today. He introduced this system. But he didn't say at your discretion, you cannot debit, you cannot credit, right? He also introduced a system where you have to do the debit and credits, right? If I go to the next slide, actually you need not to write anything, you have to listen to me, right? All the things I have uploaded just to, if you feel anything important, you can write down, but otherwise you have to carefully listen to me. And your facilities are such that you can now you need not to come to a banking institute and listen to the lectures, but after you awake or without washing your face or without brushing your teeth, in the bed itself you can log into this thing. Taking into account those things, make sure that you are counting on these benefits. Make sure that you gain something and pass the exam, right? Then Luca Pacioli, he said, this is the system to follow. He said, there are 5 types of accounts, right? There are 5 types of accounts, namely assets, liabilities, income, expenses, and equity. Asset, liabilities, income, expenses, and equity. He not only introduced these 5 accounts, he said these 5 accounts has balances. An asset should have a debit balance. An asset should have a debit balance. Then he said a liability should always have a credit balance. Then income account should always have a credit balance. Expense account should have a debit balance. Equity account should have a credit balance. You also easily by heart these things. If you take the out of 5 accounts, assets and expenses in the blue color, they have debit balances. Other 3 accounts, liability, income, equity accounts, they have a credit balance. Then he said, when due to a transaction, if an asset increase, due to a transaction, if an asset increase, you should debit that account. If it is due to a transaction and asset decrease, right? Due to a transaction and asset decrease, you should credit that account. Similarly, if you take a liability, due to a transaction, if it is increased, you should credit that account. If it is decreasing, you have to debit that account, right? If you take this double entry system, the balance column and the increase column is identical. Balance column and the increase column is identical for individual account category. You take assets, balance is also debit, increase also debit. Liabilities, balance also credit, increase also credit. Right? Then if increase is debit, decrease is credit. If increase is debit, decrease is credit. The opposite of the uh, debit and credit. Therefore, you can easily by heart this double entry system. I request you to by heart this. The only thing in the accounting for you to by heart is the double entry system, because you cannot question this double entry system. If you have a question, why, sir, you have a debit balance in the asset account, I don't have an answer. Why you debit the asset accounts when an asset increase, I don't have an answer. That's how the Luca Pacioli presented his method of double entry system. There are some things you cannot have answers in the world. There are some various things where you cannot have answers, right? Now this is the theory that he implemented, therefore we cannot question, right? But after that, apart from double entry system, balance part in the accounting you can question. Balance part in the accounting you can question, right? This is the only thing you have to by heart, right? It's very easy to by heart. There are 5 categories of accounts. You have respective balances, and the balance columns and increase column is identical. Then the increase columns and decrease column, the opposite side of the debit or credit, right? Therefore, easily you can by heart this thing, right? I will ask you to by heart this thing, taking 1 or 2 minutes. By taking 1 or 2 minutes, please by heart this thing. I again repeat, next week onward, the lecture will be started at 7 a.m. 7 a.m. It will go till 10:30, right? Without a break, I will do that till 10:30. Right. Then you know the double entry system, right? In order to practice this double entry system, you have to know what is an asset, what is a liability, what is an income item, what is an expense, what is an equity, right? And the characteristic of an asset, characteristic of liability, characteristic of income, expenses, equity, right? Now you have to know. If you know that, only you can put a correct double entry in the accounts, right? You will be given a set of transactions where you have to know whether by due to this transaction what has actually happened, whether an asset is increased, whether liability is decreased, whether income increased, whether expense is decreased, whether equity is there, right? In order to get to know that, you have to know the characteristic of these accounts categories and the nature of these accounting categories, right? Now, if I take a simple example, when a customer comes to banks and deposit money, normally you do this double entry. What is the double entry? You debit the teller cash and you credit the customer account. If I ask questions, why you debit the teller cash, why you credit the customer accounts, most of the senior people, even the AGM operations or the whatever the high rank person, they don't have answers, because that's how they put their transaction from the very beginning, even before 20-30 years back. When they start their banking, they didn't want to know why it was done. They just mere done that. If I go to that similar example again, when a customer makes a deposit, you debit the teller cash, you credit the customer accounts. That is an accounting entry, right? For you to debit the teller cash and for you to credit the customer account, there is a reason under accounting. You debit the teller cash. Why? Teller cash is an asset to the bank. It's an asset to the bank. When a customer makes a deposit, the cash of that bank is increasing. Cash is an asset. Asset increase. And go to the double entry system. Asset increase. What is the entry? Debit. Right? Then go to the other entry. Customer account credit. When a customer makes a deposit, one day we have to give that money again to that customer. From the point of view of the bank, customer account, whether it is saving account, current account, fixed deposit, whatever it is, deposit account is a liability. It has the characteristic of a liability. From the point of view of the bank, one day we have to repay that customer deposit. We have a liability, commitment to repay, right? By depositing money, from the bank's point of view, our liabilities got increased. Go to the double entry system, liabilities increase, credit entry. That's why we credit the deposit account or the customer account, right? If I come back to the example again, customer makes a deposit, we debit the teller cash. Why? Teller cash, cash is an asset to the entity, asset increase, debit that account. Then why credit the customer account? That is a liability for the bank. Any customer deposit account, it's a liability. One day a bank will have to pay. Then when a customer makes deposit, that liability is getting increased, right? When liabilities are getting increased, it should have a credit entry according to the Luca Pacioli's double entry system. That's why we debit the teller cash. That's why we credit the customer accounts. When you are making entries, you have to know that, right? You have to know that. Otherwise, when a problem comes, you don't know how to react, right? Every single entry you passed in the bank or in any other organization, you have to have reasons, right? You can question. I asked the question, why you debit the teller cash account? Why you credit the customer account? There should be some reasons. Apart from the double entry system, all other entries you can question, there should be an answer for that questions. Why you debit, why you credit, right? Therefore, make sure you learn this thing properly today, right? Before you analyzing, right? When it comes to analyzing of financial statement, that is a secondary part of this thing. We will do that thing in the next day and the week after next. But today we are covering the groundwork, right? If you don't know the accounting, if you don't know the accounting categories, if you don't know the double entry system, if you don't know the characteristic of asset, liabilities and income accounts, it will be very difficult for you to analyze the financial statements of any company, right? Then we will go to the characteristic of assets, liabilities, income, expenses very briefly. Right. First, we'll take the assets. If you take an asset, any asset, the main characteristic is it should generate some income to the organization. It should generate some income to the organization directly or indirectly, short term or long term. And it should be owned by the entity. It should be owned by the entity. I mentioned two things. An asset should generate some income to the organization directly or indirectly, short term or long term. That is income generation part. Second thing, it should be owned by the entity. Now, if you take a bank, what is the biggest asset? I mentioned loans and advances. Why we say loans and advances is an asset? It generates income to the organization. To take banks, main income generation. Banks, main income is interest income. Main income is interest income. Therefore, loans and advances generate income to the organization. And it is also owned by the entity. Banks own their loans and advances. That is an asset to their. If I take another example, if you take this IBSL, I am doing this lecture in this building, 12 stories building. That is an asset to this institute. Why? It generates some income. Directly or indirectly, short term or long term. Right? And also IBSL own this asset. Right? Therefore, when you recognize anything as an asset, you have to have those two main characteristics. What is the main two characteristic? Income generation part, directly or indirectly, short term or long term. Then it should be owned by the entity. If I go to the previous slide, this double entry system, out of this 5 category, income and expenses go to income statement. If you take the financial statements, I mentioned there are 6 components in the financial statements. Out of that 6 components, main 2 statements are the income statement and the balance sheet, or the statement of financial position. Out of these 5 categories, income and expenses will go to the income statement, previously known as profit and loss account, income statement. Then asset, liabilities and equity accounts will go to the balance sheet, or will be presented in the balance sheet, or nowadays we are calling balance sheet as statement of financial position. Statement of financial position. Right? Therefore, assets will be presented in the statement of financial position or the balance sheet. Balance of an asset is debit, then increase debit, decrease credit. Assets can be categorized based on time, tangibility, and other bases. We'll see that. These are a few examples. Assets of in a normal business organization. Cash, prepaid expenses, land, building, equipment, inventories, vehicles, account receivables. Right? Resources owned or controlled by a company. If you go to a bank balance sheet or bank statement of financial position, their asset categories are somewhat different to a normal business organization. There you can find mainly the cash, then loans and advances, investment, like treasury bill, treasury bond, SLDB, sovereign bonds, right? Those are the assets that can be found in a bank balance sheet. There are property, plant and equipment like these non-current assets, fixed asset, but it will represent very smaller part of the total asset portion. But in a normal business organization, these are the assets. Then if you take based on time, assets can be categorized into two, that is non-current assets and current assets. If you take non-current assets, those are the assets that will generate more income to the organization for a more time period. Then current assets normally last for very few months or few days, very shorter period. It generate income, but normally those are working capital requirement assets. It will indirectly help the organization to generate income. Non-current asset, few examples: land, building, motor vehicle, machinery, those are called non-current assets. Current assets, cash, inventories, debtors, those are called short-term investment, those are current assets. Then there are assets based on tangibility. Tangibility means you can touch, you can smell, you can hit, right? Those are the characteristic of tangibility. By large, 99% of the assets are tangible assets. But there are intangible assets where you cannot see the asset, you cannot feel the asset, you cannot touch the asset, you cannot smell the asset, but it generates income to the organization. Few examples for intangible assets. The famous example is the goodwill. Goodwill is an asset where you recognize, but you cannot touch, you cannot feel, you cannot smell. Any other example is if you take debtors also an intangible assets where a particular debtor is there, but here we are taking the contractual agreement between the debtor and the entity, not the physical debtor himself. Therefore, it is also considered as an intangible asset. And the other categories, fictitious assets are there. Those are bogus assets. Actually, very technical thing. I'm not going to discuss. For the time being, you may assume that you may think that fictitious asset is an, even though we call it as an asset, those are bogus assets. Only for a shorter period of time, we consider those as an asset. Even though we consider that as an asset, it does not generate any income to the organization. That's why we put the name fictitious assets. Right. We cannot waste lot of time in these areas, but I'm just covering the surface of it, the basic accounting background for you to get an understanding before we move into the financial statement analysis. Then the second category is liability. Under liability, it's very easy to understand the concept of liability. Normally, liabilities are commitments. When you commit something, you have to repay that thing, right? When you commit something, you have to repay, right? In business, when we are doing business entities, we have to commit. We have to make some commitments, right? When we make some commitment, we have to recognize the liability. Liabilities are also shown in the balance sheet or statement of financial position. You can see the liability accounts, balance is credit, increase is credit, decrease is debit. Liabilities also can be categorized on based on time and the nature. These are few examples of liabilities. Creditors claim on assets, bank overdraft, wages payable, taxes payable, accounts payable. Now, from the point of view of a normal business organization, bank overdraft is a liability.
But from the point of view of a bank overdraft is a asset, right? Why I am saying so? Bank overdraft generate interest income. When an item is generating income, it should consider as a asset. But from the point of view of normal business organization, bank overdraft does not generate any income. It has a commitment to repay. That's why we consider bank overdraft as a liability. But from the point of view of a bank, it generates income. That's why we have to consider that as an asset, right? Then based on time, non-current assets and current assets are there. Current liabilities and non-current liabilities are there. Current liabilities are the liabilities we set off within 1 year. If a liability takes to set off after 1 year, we call that as a non-current liability. For a current liabilities, we can say creditors, bank overdraft, short-term loans, all are called non-current current liabilities. If you take a term loan, housing loan, whatever the leases, those are called non-current assets. So non-current liabilities. Then taking into the concept of nature, right? Internal liabilities are there, external liabilities are there, right? Now, in the big picture, we have asset and liabilities, assets and liabilities. When you want to own an asset, it should be from two types of liabilities, that is internal liabilities and external liabilities. Internal liabilities means the owner's capital. External liabilities means other than owner, whatever the people who put capital to the entity, right? Those are called actual liabilities. When a business organization want to own an asset, it should be financed by two ways. Either owners put money to finance that asset, or we have to borrow some loans to finance that asset, right? If it is a owner's money, we say that is an internal liability. If it is a other than owner's money, we say that is an external liability. Therefore, by nature, we have internal liabilities, that is basically internal owner's capital. We call equity, right? Other name is internal liability. We can say equity capital or equity. Then external liability means other than owner's commitment, all other commitments are called external liabilities. Therefore, normally we categorize based on time the external liabilities, not the internal liabilities. Because internal liabilities, there is no time to repay those internal liabilities or the equity. We only repay that internal liability or the equity at the time of dissolution, Therefore, based on time, we only categorize the external liabilities as non-current and current liabilities, not the internal liabilities. Internal liabilities, we have a separate category called equity, right? Therefore, this is the equity, right? Internal liabilities of an entity and known as owner's capital. Internal liabilities of an entity are called equity. In Sri Lanka, you have three categories of business entities. In Sri Lanka, you have three categories of business entities, that is proprietorships, partnerships, and company. Proprietorship, partnership, and company. In proprietorship accounts, we used to have capital account to represent the equity. We are using capital accounts to represent the equity. In a partnership, you have two accounts, capital accounts and current account to represent the equity. In company accounts or listed company or a limited liability company, you have what is called stated capital. Stated capital plus reserves to represent the equity. Therefore, when you are analyzing also, make sure you take into account these three things. In a proprietorship, you have capital accounts to represent the equity, because the equity part is very important. When you are lending to a organization or when you are lending to a person, the equity contribution is very important. Therefore, when you are taking that thing, make sure that you take in a proprietorship only the capital account. If it is a partnership, you take capital and current account. In a company, you have to take the stated capital and the reserves to represent the equity part. We know equity also will get represented in the balance sheet or the stated in the statement of financial position. Balance is credit, increase is credit, decrease is debit. Owner's claim on assets, contributed capital, retained earnings means reserves, dividends are a deduction of equity. Those are also called equity parts. Then expenses, very easy to identify. Payments made or due to be made by an entity to generate income. When you want to generate income, you have to incur expenses. In a normal business organization, main income is sales. When you want to make sales, you have to purchase. Therefore, purchase is the main expense item, right? In order to generate income, you have to incur some expenses, right? Expenses are shown in the income statement or the P&L. Balance is debit, increase is debit, decrease is credit. Expenses can be categorized as follows. Recurring expenses, capital expenses. Actually, normal expense, definition of expense will be the recurrent expenditure only. Capital expenditure is not a expenditure. It will be an acquisition of a asset. We'll see the differences. Capital expenses. I will take two examples. A business organization purchase a machinery and making an electricity bill. Those are the two expenses. Purchase a machinery and making an electricity payment. We go to the two characteristic. Capital expenses not occur on a frequent basis. Occur on a frequent basis if it is a recurrent expenditure. Now go to the two examples I quote. Purchasing a machinery. Purchasing a machinery not occur on a frequently basis. This month also we are purchasing, next month also we are purchasing. Machineries are very high in value. Therefore, we cannot purchase every month a machinery per month. But when it comes to this electricity payment, you have to make electricity payment every month. In order to do the business, every month you have to make the electricity payment. Then number two, expense value is material, expense value is not material. When you purchase a machinery, the expense value is material. But electricity payment, that is not that much material. Now, these days, the electricity bill is also material, very high, but compared to a purchase of a machinery, it is not that much material. A fixed asset will be acquired. When you purchase a machinery, that is called a fixed asset, a long-term asset, an asset that generates income for a longer period of time. These are day-to-day expenses. Electricity payment, you don't have a asset acquired. Those are general payments. Finally, reflect in balance sheet or statement of financial position. When you purchase a machinery, it will be an asset. It will go to the balance sheet or the statement of financial position. When you make electricity bill payment, that is finally reflected in income statement. Income statement. Therefore, recurrent expenses are called normal expenses. Capital expenses are not normal expenses. Those are acquisition of assets. And the final category is income. Final category is income. Income are called received, or due to be received by an entity via selling of items or offering services. When you do business for income, right? Income are shown in income statement: balance credit, increase credit, decrease debit. Income can be categorized as follows. Main income and other income. If I quote a few examples, in a bank, the main income is interest income. When you have investment income, those are called other income. But in a company like Dialog, right, the main income will be prepaid and postpaid charges. Their interest income is another income. If you go to insurance industry, the main income would be the claims, the premiums that they receive from life or general policies. The other income may be interest income. In a normal business organization, the main income is sales. Other income would be rent income, interest income, likewise. These are the different two categories. Receive on a frequent basis, the main income. Not receive on a frequent basis, the other income. Income value is material. If you take the total of main income, the value is material. Income value is not material, other income. Finally, reflect in the trading account of income statement. Main income go to the trading account. The other income will go to the second part, that is P&L, profit and loss account. There are two parts in the income statement. The main income will go to the trading account. The balance part will go to the other income. In a published financial statement, when you are publishing a financial statement, the main income will be at the very top, whereas the other income will be reflected in the latter part of the income statement. Right. Up to now, I have discussed the double entry system, the main 5 categories of accounts, and their characteristic. If you have any questions up to now, you can raise now. Before I move into the next part, if you do have any questions, please raise now. Right. Okay. Right. I think my message was clear. Last time we did have this online session. Out of the students who sat for the exams, only 50% people got through the exam. It was due to 2 reasons. One might be these online sessions and no physical people are not coming for physical lectures. That might be one reason, and the other reason, the structure was also changed. There were 2 papers where one section is the analysis of financial statements. You have to get a minimum marks from that section, and the other section is the balance part of your theoretical aspects of the credit management. To get through the exam, you have to take average mark in those 2 papers. Therefore, make sure that you take into account those things when you are doing the exam this time. Anyway, we cannot check the main disadvantage is we cannot see whether you are listening, whether you are actively participating, whether you understand the things. If you do want to clarify anything, make sure that you even you can send a message also. If you do not want to uh, voice your thing, you can send a message also, right? Language is also not a barrier. You can ask using any language. Please speak if you want to ask any question. Right. We'll move to the next part. That is accounting equation. Right. In accounting, we call assets equals liability plus equity. It derives, if you take assets as a debit. In accounting, we say debit equals credit. Debit equals credit. If you go to this formula, assets is a debit balance. Then equals liability also credit. Equity also credit. Therefore, assets debit, liability and equity credit. Debit equal credit. Right? That's how this formula has been derived uh, on the basis debit equals credit. You have assets which represent debit balances, and liabilities and equity represents credit balances. We have a scale also, assets equals liability plus equity. Then if I add a few things to the equity part, right? Forget about the first two items, that is contributed capital and dividend. Other two parts, that is revenue and expenses. Revenue and expenses. Revenue means income, expenses mean our day-to-day expenses. If you forget about the first two items, that is now we will discuss the two items also for the easy reference. Contributed capital, when you contribute more capital, your equity will get increased. When you pay dividends, your equity will get decreased, right? Then revenue, if you take, that is income will be credit balance. That's why we add to the credit side of the formula, right? Asset side is a debit side, liability and equity side is a credit side, right? Revenue or the income will be a credit balance. That's why we add that thing. To take expenses, expenses is debit balance, right? Either you can add expenses to the assets or you can deduct from the equity. That's why we deduct the expenses. Anyway, income minus expenses or revenue minus expenses means profit or loss. Revenue minus expenses means profit or loss. Any profit or loss will get added to the equity because they are the owners of profit. Owners of profit. Right. This is the same formula. Assets equal liabilities. Then assets equal liabilities can be divided into internal liabilities and external liabilities. Then third one, assets equal internal liabilities are called equity. Internal liabilities are called equity plus external liabilities. Plus external liabilities. Then final formula, equity plus or minus income minus expenses. Income minus expenses will be profit or loss. That's why equity plus or minus income minus expenses. Then plus liabilities. Same thing again. Right. This is the format of a normal ledger account. This is the format of a normal ledger account. You have debit side up to these points. This is called debit side, right? From this point onwards, this is called credit side, right? Debit side and credit side have similar columns. If you take the first column, date, both sides have dates. Then the second column, description, both sides have description. Then the ledger page, both sides have ledger page. Then the value. Date means when you are putting a transaction, or what is the transaction date. Date is, what is the transaction date? The date on which the transaction occurred, right? When you are putting something in the description means, for example, assume this account will get debited. When you debit this account, what is the credit account? The name of that credit account you have to write here. And similarly, when you are crediting that other account, there the description column, the credit side, you have to put the name of this account, right? Then ledger page means, previously we have these books called ledgers, right? In a ledger page, this might be ledger page 1, the other entry might be in the ledger page 100. You have to have the references. In this ledger account, you have to say 100. In that ledger account, go to the page 100 and say page number 1. The value is value of the transaction, right? Even though we use this format, normally we use the T accounts when it's come to double entry, right? When we making entries, we used to have the T accounts for double entry purpose. Right. I will break for 10 minutes and we'll start the lecture again at 10. Right. Please join the session again at 10, right? Right. We'll again start the session. Up to now, we have identified under accounting the main three categories of accounts and their characteristic, and how we have to debit or credit the respective accounts when we come across a transaction. Right. Now we will do some transaction analysis. We will take a few transaction, and you have to get to know about these things with a good understanding why we debit this account, why we credit that account, right? Now, first transaction we'll take Mr. J. So J is the owner of a particular business. He is the main owner of a particular business. He puts 20,000 cash to start the business as a capital, right? Mr. J is the person who is owning this particular business. He puts 20,000 to start the business. In accounting, there is a concept called unit concept, where you have to wear the spectacles of, or the spectacles from the side of the business, not from the sides of the owner. Every transaction you have to look from the side of the business, not from the side of the owner, right? You have to have a clear demarcation between the owners and the business, right? Uh, Therefore, every transaction you have to look at from the business, not from the side of the business owner. Even the owner puts money here in this transaction. Owner puts money to the business, 20,000. Even though owner puts money, we have to take that as a liability. That is called internal liability. Internal liability, right? We have a liability not to the external party, we have a liability to the internal party. Internal liabilities are called equity. Internal liabilities are called equity. We have learned that thing, right? Internal liabilities are called equity, right? Every time owners entitlements, owners claim on assets or owners claim on the business are called equity. You know, equity account should have a credit balance, increase credit, decrease debit, right? When owner or the J puts money to the business, 20,000 from the side of the business, what will happen? Business receive cash. Business receive cash. Cash is what? Cash is an asset to the entity. Cash is an asset to the entity. When owner puts money to the business, business receive cash. Cash is an asset. Asset is increasing. When asset is increasing, what is the double entry? That particular asset should get debited. Will have to be get debited. That particular asset is called cash. We have opened a cash account and we have debited that account, 20,000. In the cash account, we write the capital account, that is the account that we are going to credit, right? If you want to move on to the credit entry, apart from receiving cash by the business, they also receive a liability from the side of a business owner. That is called internal liability. When liability or the internal liability or the equity, internal liabilities are called equity. When equity increase, go to the double entry system. Lucas Pacioli's double entry system. When equity increase, equity account balance is credit, increase is credit. When equity increase, we have to put a credit entry there. That's why we credit the capital account. This is a single proprietorship. In a single proprietorship, equity will get represented by a capital account, right? Therefore, capital account will get credited 20,000. Here we have to write cash. Now, if I summarize the whole transaction again, we debit the cash account, we credit the capital account. Why we debit the cash account? Cash is an asset to the entity. That assets got increased due to this transaction. That's why we debit the cash account. Why we credit the capital account? Why we credit the capital account? Since that is only the left with us, right? Since we have used the debit entry, we are only left with the credit entry. That's we credit the capital account. No, that is not the reason. For capital account to credited, right? When we receive cash, also when we have a commitment from the side of the owner, owner's claim, owner's commitment for the business, right? Owner's entitlement, that is also represented by way of equity. Equity also got increase. Equity increase, go to the double entry system, that is a credit entry. Therefore, debit cash, credit capital account. Debit cash, credit capital account. If you have any question, you can raise. I think All are clear. Shall we move to the next example? Similar business, we'll take the next example. Now we have debited the cash. We have 20,000 worth of cash in the cash account. And similarly, capital accounts also, the credit side, 20,000. Every debit, every credit that you put in the accounts in a business organization should have a valid reason. The reason I mentioned, when you debit the cash, that is because of asset increase. When you credit the capital account, that is because your equity also got increased. Right. Next one. Purchase stocks or supplies. Purchase stocks or supplies. Paying 1,000 in cash for resales. We have purchased some stocks or supplies by paying cash. Right. The answer is there, but don't look at the answer. When you purchase something for resale, when you purchase something for resale, right? The purpose of this purchase is to resale, right? In order to sell some item, you have to purchase, right? Purchase is the main expense of an entity. Purchase is the main expense of an entity, right? When you purchase, your expenses will get increased. That's why we debit the purchase account. We debit the purchase account because when you are purchasing, your expenses will get increased. How did you purchase? By paying cash. When you pay cash, cash is an asset. When you pay cash, your assets will get decreased. When you pay cash, your assets will get decreased. Assets decrease. Asset account debit balance, increase debit, decrease credit. That's why we credit the cash account. In the purchase account, you write the cash. In the cash account, you write the name purchases. Transaction number 2. You debit the purchase account because it is an expense increase. Expense accounts, debit the balance, increase debit, decrease credit. When you are purchasing, your expenses will get increased. That's why you debit the purchase account. When you are purchasing, your cash also got reduced because you paid the cash. Cash is an asset. Asset decrease, you have to credit the cash account. If you have any question, you can ask. Otherwise, I will go to the next example. Right. You may think that is some foolish question, but that foolish question might be in the minds of other people also. You are only asking that question. But anyway, you can ask, right? Okay. Then transaction number 3. You purchase an equipment for 15,000 by paying cash. Don't look at the answer. Imagine yourself what account to be debited, what account to be credited. You purchase an equipment by paying cash. When you purchase an equipment, you get an equipment. Equipment is what? Equipment is used to generate income. Therefore, that is an asset to the entity. Asset increase, then you have to debit that equipment account. How did you purchase? By paying cash. Cash also an asset to the entity. By paying cash, you reduce or you decrease your cash position. Asset decrease. Therefore, you have to credit the cash account. Then number 3 entry, equipment account will get debited because an asset increase. Your cash accounts will have to get credited because your asset also, cash also an asset, it got decreased. Now this double entry system is very logical. If you do have a simple maths knowledge, very easy to understand, very easy to pick, right? Very logical subject. You cannot by heart anything other than the double entry system itself. Nothing has to be by heart. Everything is logical. Everything can be questioned again and again. There should be a reason for every debit and every credit in the accounting. Apart from the double entry system, anything can question. I started my career at Jayawardena University as a lecturer before joining the banking industry, where I could find lot of students. They by heart the accounting and doing the A-level examination and go through the university. When we do the university education first year, second year, some students were getting struggle to learn the higher categories of accounting techniques and accounting modules, because they are trained to by heart. Accounting is not a subject of by hearting thing. That is very logical, very relative subject. You can question, you can argue, you can make comments. Everything is there. Nothing to by heart. Right. Then we'll move to the next example, number 4. Same institute. Here, purchase stocks for 200 on credit and equipment for 1000 on credit from A Limited. There are 2 transactions. First transaction, we purchase item for resale, this time not for cash, for credit. Second transaction, we also purchase an equipment from A Limited for 1000 rupees, not for cash, for credit. Right. Go to the number 4. First transaction we'll take, that is credit purchases. Whether you are purchasing on credit or cash, you have purchases. Therefore, purchases is an expense to the entity. The mode of purchasing doesn't matter when it's come to accounting for purchases, right? Purchases is purchases. Whether it is on credit or cash, purchases is an expense. Therefore, you have to debit the purchases account, right? Expense increase, purchases you have to debit. Since we have not paid cash, we have committed to a liability to pay cash on a future date. That is called creditors. That is called a liability, right? This 200 will have to be paid in future date. Those are called liabilities or commitments. The name of that liability is creditors. Therefore, increase in commitments, increase in liabilities, there should be a credit entry. There should be a credit entry. Right. Then the second transaction in the same example, that is purchasing or acquiring equipment for 1,000 on credit from A Limited. Transaction number 3, we had equipment purchase for cash. This time also equipment purchase. Therefore, the mode of payment is not matter, but where we have a equipment. Therefore, we have to debit the equipment account. Reason is asset increase. Asset increase. Right? Previous transaction we made cash payment. This time we are not paying cash. We have a commitment to pay in a future date. When it comes to commitment, those are called liabilities. Therefore, we have a liability called A Limited, 1,000 rupees. We have to credit that account because liability increase. Liability increase. If I summarize those two transactions again, first transaction, credit purchases. Whether it is credit or cash, we have purchases. Purchases is an expense increase. Expense increase. Therefore, we have to debit that expense account. Then credit purchases, since we are not going to pay cash, we have committed a liability. That liability's name is creditors. Increase in liabilities, we have to credit that account. Therefore, we credit the creditors 200. Then the second transaction, equipment purchase from A Limited on credit basis. Right? Whether it is credit or cash, we purchase an equipment. Therefore, we have an asset. We have to debit that asset account. We have to debit that asset account. Then we have to credit the A Limited account by 1,000 rupees. Since we have increased our liabilities in the name of A Limited. I think I am very clear on these two transactions. If you have any questions, you can ask. Right, we'll move to the next transaction. That is transaction number 5. Borrowed 4,000 rupees from ABC Bank. This entity, they borrowed 4,000 rupees from ABC Bank. Right? When you borrow 4,000 rupees, you will get cash. Therefore, cash accounts will get debited 4,000. Cash account will get debited 4,000. Then you have a liability called ABC Bank Loan Account. ABC Bank Loan Account, where you have to make payment in a future date. That is called a liability. Liability also increase. Right? Liability increase, that will be a credit entry. Credit entry. 4,000. To debit cash, you credit the ABC Bank Loan Account. That is a liability. Right. Now we have finished with the 5 transactions. Now here I am going to tell you how do you balance an account. Now I took the cash account of these 5 transactions. When you are balancing an account, you have to first get the total of the 2 sides and take the higher total. In this account, the cash account, the debit side you have a 24,000, credit side you have a 16,000 in totals. Then the highest one is 24,000 in the debit side. You have to put the highest total in both sides. 24,000 to 24,000. Then using the term balance carried down, BCD balance carried down, you have to take the balance from the credit side. The same balance will have to get repeated in the debit side. When you have a balance carried down in the credit side, balance brought forward will be there in the debit side. Therefore, if you take the balance of an account, normally we refer the balance of an account to balance brought forward account. Balance brought forward amount. Here, if you take the cash account, the balance is balance brought forward from the debit side. Therefore, balance is debit 8,000. Debit 8,000. Likewise, you can balance every account that you have encountered using the same methodology. Once you take the balances of all accounts, that is called a trial balance. I extracted a trial balance in the 5 transactions that we have done with you. If you take the cash account has a debit balance of 8,000. Debit balance of 8,000. Then capital account, it has a credit balance of 20,000. Credit balance of 20,000. Purchase account, you have a debit balance of 1,200. Debit balance of 1,200. Then equipment account, you have 2 equipment purchase, one on cash, one on credit. 15,000 and 1,000. Therefore, total is 16,000. Creditors is a liability. It has a credit balance of 200. A Limited also again a liability. It has a 1,000 credit balance. Then finally, ABC bank loan account. That bank loan account also 4,000 credit balance. The balances of debit total and the balances of credit totals will get tally. 25,200, 25,200. That is not a magic. When you put the same value in debit side and the same value in the credit side, your trial balance will get tallied. But tallying trial balance will not reflect 100% accurate accounting, right? For a trial balance to get tally, the only the requirement is to whether it is correct or wrong, debit side and credit side entries to be identical, right? Whether you debit, whether you credit the same value to a wrong account, incorrect account will also facilitate the tallying of a trial balance, right? That is also arithmetic accuracy only, not the correctness of the accounts, right? Now, if I go to an example, right? Now, in this last account, if you take borrowed 4,000 from ABC Bank, we debit the cash account, credit the bank loan account, right? Assume that we debit the ABC bank loan account and credit the cash account. Still, the trial balance will get tallied, right? Therefore, mere tallying of trial balance will not assure you that you have correctly accounted all the transactions. To get it tallied, a trial balance, only requirement is you have to put a debit entry and the same entry have to be put it into a credit side of an account. Therefore, still you can find lot of errors even with a tallied trial balance. Right. Now, I also again call few transactions from a bank's point of view. This is the transaction I referred when I commenced the double entry system. A customer makes a deposit. Now you should be in a position to tell me why you debit the teller cash account, why you credit the customer's deposit account. A customer makes a deposit of 4,000 rupees, teller cash account debit, customer deposit account credit. Now you know for sure, I know for sure the reasons that you know for these two debit and credits. Can you recall yourself? Why you debit the teller cash account? Why you credit the customer deposit account? When a customer makes a deposit, right? From the bank's point of view, banks receive cash. Cash is an asset. Bank's cash position will get increased. Here the representation of cash, the account will be teller cash. In a bank, there would be several representation of cash accounts. Teller cash, vault cash, owning officer cash, ATM cash, drop safe cash, right? There are a number of accounts to represent cash, right? Here the customer, when customer makes a deposit, it will go to the teller cash account. That's why we have a teller cash account. That's why we debit the teller cash account. Every day, the individual teller will have to balance the teller cash accounts, the physical cash with the teller GL, right? Therefore, the logic behind why we debit the teller cash account, because banks cash position increase, cash is an asset, asset increase. Why we credit the customer deposit account? Because we don't have any other account to credit. No. That is not the reasons. When customer makes a deposit, that customer will come back in a future day and ask for that money. Therefore, from the bank's point of view, that is a liability. That is a liability, right? I put every effort for you to understand these concepts today: asset, liability, income. Now, in the last lecture, if I ask again whether deposit is an asset or liability, if someone say that is an asset, then I am in this fifth floor. I will open one of these windows and jump up, right? Jump out and kill myself, right? Therefore, make sure that you learn the characteristic of an asset: liability, equity, expense, income, right? After 4 days of lectures, final day, I will again ask someone whether loans and advances are assets or liability. If somebody tell me it is a liability, then what can I do? Right. Therefore, make sure that you 100% learn the basic accounting, right? When you are to analyze the financial statements of one of your borrowers, it is very important that you understand the basic concepts of asset, liabilities, income, expenses. When you are going through the financial statement, income statement, balance sheet, there are asset, liabilities, income, and expenses. If you don't if you don't correctly understand the concept behind the asset, liabilities, or the accounting concept, it will be very difficult for you to give a correct picture to your higher authority to make a decision, or a decision by yourself, right? Therefore, for this transaction, teller cash account debit, the reason is teller cash is an asset, asset increase. Customer deposit account credit, the reason is customer deposit account, when a customer makes a deposit, we will make a commitment. That commitment is there until we settle that commitment. Therefore, liability increase are credit, right? A customer withdraw 2,000 from the counter. That particular customer's deposit account has 3,000. He withdraw 2,000 from the counter. Particular tellers, originally they have a teller cash balance of 5,000. When he disbursed the 2,000, customer account will get debited and teller cash account will get credited. Why we credit the teller cash account? Because our cash is an asset. We give away the cash equivalent to 2,000. Decrease in asset. And when customer withdraw some money, our commitment to that customer will get reduced. Liability decrease. Liability decrease is what? Liability balance, credit, increase credit, decrease debit, right? I hope everyone is clear. Nothing is asked. It means two things. Whatever I taught you up to now, everyone got a very clear understanding. Then the other thing is everyone hasn't got anything cleared up to now. That's why they are very speechless. Right. Okay. I hope the first assumption is correct. Right. Then when you are analyzing the financial statement, it's very important. I will come back to this point again and again when we discuss the in the later stages also. You have to visit the customers. These days, it's very difficult for you to visit customers, but when times come, you have to definitely visit the customers place to get an understanding. When you are visiting the customers, make sure that you get a good understanding of the accounting as well. Make sure that he has the correct controls, correct aspects as far as the control environment is concerned, right? Uh, Basic primary books are there. Now, these primary books, we used to have these primary books before. If the customer has similar nature transactions, uh, more than what can be accommodated by a single day, then those customers can use these primary books before entering all the transactions to the ledger accounts. A few primary books are I mentioned here: cash book, single, double, triple column cash book. Then purchase day cash book to write the credit purchases. Sales day cash book to write the credit sales. Then return inward day books to write the inward or return sales. Uh, then return outward day book to write the return purchases by the entity, then the petty cash book and the main journal. Now, I have given a few formats also. When it comes to these formats, there is no specification. The only specification for format is given by LKS1 for publishing the financial statement, where under LKS1 you have to use that format when it comes to publish financial statement preparation. Apart from that, uh, every entity is free to have their own format, provided that they serves the purpose. Now, this is basic format for a single column cash book. You have this date, description, ledger page, cash receipt number, and cash. A single column cash book is used by entities where they do not use the check transactions. They don't accept check. They don't issue checks. They only use for transaction the physical cash and notes. Under the debit side, you have cash receipt number. Under the credit side, you have cash payment voucher number. These are very good controls. When it comes to payment, there should be a payment voucher prepared by the customer. That payment voucher should be approved and authorized by the authorities. And the payment voucher also should be supported by a source document, right? Those are the things that you have to be worried about when you are visiting the customer's place. If you get a chance, uh, verify the accounting background and the accounting environment of that particular entity. That will facilitate your credit decision as well. You can see the financial statement preparation process also there. If it is good, then you can highly rely on that financial statement as well. Right. When a customer used checks or current accounts to pay cash or receive cash, those customers will use the double column cash book. Instead of one column for cash, they have an additional column called bank. Uh, if you have two method of payments, not only the physical cash, but using the check payment and check receipts, you have to use this double column cash book. Same format, only one column is added to the debit and credit side of the format. I again repeat, these are very simple formats. Any formats can be changed or amended due to the requirement of particular entity, provided that they support the purposes for which this particular cash book is prepared. Then the triple column cash book, where when you have debit, when you have credit purchases and when you have credit sales, you have debtors and creditors, right? Sometimes people encourage early payment from debtors and creditors. If you have debtors, if you give 1 month credit period to debtors, if you want to get early money, you will see to debtors, we will give a discount if you pay. Even though you have 1 month period, if you pay within 2 weeks, we will give a 10% discount. Similarly, when you have creditors, your creditors may contact you and offer similar kind of discounts. Now, in order to write those discounts, discount allowed and discount received, you have to have another column in the debit and credit side of the cash book. If you do record those discounts, you have to have a triple column cash book prepared. Actually, if I have time, I can, if I can do with some examples, it's better. But due to the interest of time, I may not have time gaps to do some examples for triple column cash book, double column cash book, and single column cash book, and even for these subsidiary books. Make sure that if you are interested in, you can go to any A-level commerce students teaching materials. They have enough examples, right? I just briefly explain what is the purpose of these primary books. Then purchase journal. This is a simple format of a purchase journal. When you have more credit purchases for resales, you have to have a purchase journal. If it is being frequently done, normally without recording the transaction at the inception to the ledger accounts, initially you record the transaction in the purchase journal. Thereafter, a summary of this transaction will go to the ledger accounts. If you take the January month, all the credit purchases total will go to the ledger account instead of making one by one. If you have large amount of transactions in terms of credit purchases, you have to use the purchase journal. If not, otherwise, forget about the purchase journal and uh, directly record all transaction in the ledger. Similarly, if you do have credit sales, you can use a primary books on time to time on a primary basis. On a periodic basis, you can record the transaction to the uh, uh, sales journal. If you have any questions up to now, please let me know. Right. Then next one is return outward journal and return inward journal. When you have sales return and when you have uh, somebody has a question, we'll see. Why do we create a limited account? Why should not credit to creditors account? Now, if you have a now you are referring to this, I suppose this transaction. No, this one. Yes, this one. Instead of crediting a limited account, why didn't we credit the creditors account? When you have a creditor's name given, you can. This is also creditors account. The difference is we have a name given. If you take creditors, it's general, right? If the name is given, we have to have a separate account. This is also a limited account is also creditors account, right? Then equipment is not purchased for credit, so it is not come under credit account. Equipment is purchased on credit, right? Here, equipment of 1,000 rupees on credit from A Limited, right? If it is for cash, no need to go to the creditors, directly credit the cash account. Cash account is an asset to the bank. Yes, cash account is an asset to not only for the bank, for any organization, cash is an asset, right? I hope I answers all the questions. If you do have any questions, you can again send me. Right. Return inward journal and return outward journal. When you have credit purchases, when you have credit sales, if the quality, if the quantity, if the variety, if the brand name is not matched with your requirement, you can return, right? Similarly, when you purchase also, you can return. When you make purchases, if the customers, those who purchase from yours, they don't accept the quantity, quality, and the brand, everything, he can also return the things, right? In order to write those return purchases and return sales, you have this return inward and return outward journal, right? Then petty cash also, apart from the main cash, there are some petty cash things. Apart from the main cash, there are some petty cash things. Petty cash things cannot be, the petty cash amounts are very small. Therefore, you cannot record those transactions in the main cash account, right? The main cash account will get cumbersome or will get lengthy when you write these small amounts. Therefore, in accounting, we normally used to have a different cash book called petty cash account in order to record these small amounts, right? Normally, there is a system called petty cash impress system where a petty cashier will be given some amount, say 10,000 to 20,000, and he is asked to do the petty cash payment. After 1 month, he will have to again meet the main cashier with the source documents that he has spent for as petty cash, right? Say, assume that he originally he has given 20,000, he has spent 15,000 for petty cash. Therefore, the supporting documents for 15,000 he has to produce to the main cashier. If the main cashier is satisfied, again he will give 15,000. Again, that imprest will go to 20,000. Originally, he had 20,000, he spent 15,000, and he met the main cashier with the 15,000 source document and the expense items. If the main cashier is satisfied with the source document, he will again give the 15,000 to the petty cashier. Again, that petty cashier's interest will go to the 20,000. Again, he can make petty cash payment up to 20,000. That is called petty cash interest system, and the recording will happen in a petty cash book. Then main journal. Other than any other, now we said cash book, petty cash book, purchase journal, sales journal, return inward, return outward. If you take any other transaction happen in an organization, before write into a ledger, those will go to the main ledger, sorry, main journal. There are 5 categories of transaction normally we record in a main journal. Those are called opening transactions. Then number 2 is purchase or sales of fixed assets on credit basis, right? If it is on the cash basis, we'll go to the cash book. If it is on credit basis, won't go to any other books. Therefore, main journal is the place where that has to get written before making entries to the ledger accounts. Then the third one is correction of errors. When you come across any errors while you are doing accounting, it has to initially record before correcting the error. It has to initially record in the main journal. After recording in the main journal, you have a journal voucher. Thereafter, the correction entry can be made. Then there is another entry called closing entries. Those are also coming under main journal. And the final entry thing is adjustment entries. In order to make adjustment to the financial statement, you are making some adjustment entries. That is also covered under main journal. It will take some material time. If you want to learn those things, you can go to any A-level materials and get an understanding about these entries. Right. Then we'll come to the financial statement preparation process, right? Normally, I mentioned at the beginning of the lecture, if you take the definition of financial statements, there are 6 components. First one is the income statement. Then so can you upload the tudes before class started so we can get a printout and attend to this class? I think this was uploaded well before, I assume, because I have given this tutorial and everything, presentation, everything about 2 months back. Hope the administrative, I will check with those people, right? I hope this is there in the your system, right? Because I have given these tutorial and presentations well before 2 months, right? I make sure that is there, right? Right. Financial statement preparation process. If you take the financial statement preparation process, at the year end, we have to close the income and expenses accounts, because out of that 5 accounts, asset, liability, and equity accounts will the balances of those accounts will go to the next year. Only income and expenses accounts will get 0 and will transfer to the income statement, right? At the year end, we'll take a trial balance and prepare the income statement and the balance sheet. Out of the main 6 statements, those 2 statements are the main statement that we prepare for a organization. The cash flow statements will be prepared on different basis, and the statement of changes in equity also based on the 2 statement I mentioned, income statement and statement of financial position. We will have some extracts for these statements. And accounting policies is a qualitative thing. Accounting notes also part and parcel of the first 2 statements. The component I discussed, if you take the financial statement of different entities, financial statements have different technical jargons. If you take the banking industry, the technical jargons may be currently loans and advances, treasury bill, treasury bonds, non-performing loans, cost to income ratio, impairment, right? Those might be the technical jargons of a bank. But when it's come to the hotel industry, they do have very different technical jargons in the financial statements. They may have these refurbishment cost, occupancy ratio, right? Similarly, when it's come to rubber or tea or coconut state, right? There also we have different technical jargons like nurseries. If you take nurseries, those are called infant plants. Those are called nurseries, right? Therefore, different entities have financial statements similar to the same nature, but where you can find different jargon, technical jargons are there appearing in the financial statements, right? The format of the financial statement, it is given in under LKS 1, Lanka Financial Statements 1, Lanka Accounting Standard 1, LKS 1. The format is given for every entity to publish the financial statements. If it is not a published financial statement, then they can have their own format. LKS 1 talks about the published financial statements, but when it's come to banks, the Central Bank of Sri Lanka, they have provided formats for the financial statements. But for other institutes, they will have to follow the LKS 1, the presentation and preparation and presentation of financial statements of a listed of a published financial statements. But if it is for internal use, the management account, they can have their own format, right? In order to minimize the gaps between financial statements, there is called what is called accounting standard, right? If I take a simple example, now we have say a mason bars, right? Two mason bars are there, right? We will give them similar amount of these cement, sand, building material, everything will be given to them on an identical basis. Say, and timber, everything will be given on identical basis. Then we'll ask them to build house, and similar square feet area will be given to these two mason bars. After some time, say after 1 year, we come and have a visit on these built houses. One mason bars may build a one-story house. It may have two rooms where two attached bathrooms are there, right? There in that house, the kitchen is very big, right? And if you go to the other house, it may be 2 stories. There can be 4 rooms, right? There is no any attached bathrooms. Common bathrooms are only there. The kitchen is very small, right? Even though we gave them the identical building materials, since we have not given a plan to build the house, they build the house on their own. Assuming that apart from giving the building materials, we have also given a plan, identical plan to build the house, right? In that case, after 1 or 2 years, if we come and visit the place, they will build the house. It may not be identical, but very small uh, 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 in matching, not matching aspects are there. The size of the house, the number of stories, number of rooms, number of attached bathroom, the size of the kitchen, right? Everything may be, even though not identical, but more or less similar in those two houses. Similarly, when it comes to accounting, if the accounting standards are not there, the accountant may prepare their own set of financial statements on their own in different formats, different nature. They may prepare the financial statements as they wish. But in Sri Lanka, there is an act called number 15 of 1995, Accounting and Auditing Standard Act, where they have given powers to Institute of Chartered Accountants of Sri Lanka, Sri Lanka. They have given that institute the power to determine the accounting structure of Sri Lanka, right? Where they have put a committee called Accounting Standard Committee, and they will produce new accounting standard. They will abolish the old accounting standard. They will make amendments to the existing accounting standards, right? That particular committee, right? Sri Lanka Accounting Standard Committee, they have the sole power to determine the accounting standards of Sri Lanka, right? After they develop the accounting standard, they will put that accounting standard to their council, the Council of Institute of Chartered Accountants of Sri Lanka. After their approval, the accounting standard will go to the parliament. Normally, when something goes to the parliament, the people are arguing with it. Opposite people and the members of the parliament, everything is government side and opposite side. Every people are arguing when something is presented to the parliament. But when it's come to this accounting standard, nobody will be arguing because they don't have that much of knowledge as far as the accounting standards are concerned. It will get approved. Once the parliament approval is there, it will get gazetted and it will become the laws of the entity, country. Every entity, when they prepare the financial statement, they will have to follow these accounting standards, right? And apart from that, there are some requirements from Company Act. There are some requirements from Security Exchange Commission. There are some requirements from Banking Act. There are some requirements from the insurance, wherever applicable, right? All has to get followed when they prepare the financial statements, right? Since there are accounting standards, the more or less the similar industry, if you take banks, all the banks' financial statements will be more or less similar. Because of that, we can easily compare and contrast the one bank's financial statements with another bank. One bank financial statements with another bank. Similarly, if you take insurance industry, all the insurance companies' financial statements more or less similar. Telecom industry, more or less similar. Leisure, education, whatever the industry, if you take the hospital, the similar nature, even though the industry-wise content might be different. The items in the financial statement in a hospital industry might be different from a bank's financial statement. But if you compare the similar industry, more or less similarities are there. The people can easily compare and contrast and analyze and come to conclusions. That is the purpose of these accounting standards. Now, when you're analyzing also the financial statements of your clients, make sure that is in accordance with the accounting standards, right? That is accordance with the accounting standards. Actually, the chartered accountants are, when they audit, when they prepare the financial statement, they use these accounting standards. Right. Then SLAs versus SLFRs. SLAs versus SLFRs. Another question is there. What is that? I got it. Thank you. Right. Okay. Right. Everything is uploaded in the system. You can not only go to the today's lecture, all 4 weeks lecture tutorials you can download and get a printout. It's very easy for you to, when you listen to the lecture, it's very important. Right. Up to now, if you have any question, you can ask. If not, I will take to the next slide. Right. Up to 2012, the accounting standards are called SLA, Sri Lanka Accounting Standards. From 1st January 2012, the names were changed. Right. Actually, after 2011, the SLAs were there, Sri Lanka Accounting Standards were there. All the Sri Lanka Accounting Standards were renamed from 1st January 2012 as Lanka Accounting Standards, LKS, or Sri Lanka Financial Reporting Standards. Sri Lanka Financial Reporting Standards, SLFRS, and Lanka Accounting Standards, LKS. There was a huge change to the accounting standard. Then thereafter, there was another change made in 2018. First up to 2018 and 1st January 2019, the some SLFRS accounting standards were materially changed. Right. We'll go to the second set of tutorials, presentations. I have also uploaded that thing. I think up to now, basic accounting techniques have been covered. If you do have any question, you can ask before I start the next session. Why are we prepare in the financial statement once a month? It is a legal procedure or not? We are not preparing financial statement for legal requirements once a month. Once a month, we prepare the financial statements for management requirements. In the preparation of financial statement for management requirement, there is no specific format. If you take our bank also, financial statements prepared on a monthly basis, those are called management financial statements. Those have in detail items where board of directors, management people, they want to have access to these financial statements. They want detailed information. But when it's come to preparation of financial statement for publication, for banks, there is a special requirement to publish their financial statements on a quarterly basis. There is a special requirement. Apart from banks, other institutes only publish their financial statements once a year. That is 12-month period. But any organization, they will prepare the financial statements on a monthly basis to get an idea about the business. That is called management financial statement, right? I think I have answered your question. There is no legal requirement to prepare the financial statement on a monthly basis. But for banks, there is a quarterly requirement. Even for bank, there is a monthly requirement for sending financial statements for central bank in a different format. But that format is somewhat differ from the management financial statement prepared on a monthly basis. For banks only, we have these quarterly requirements and monthly requirement for central bank. Quarterly requirement for publication in the paper. But when it comes to other institute, there is no monthly or quarterly requirement. But if it is a listed company, listed in the shareholder Colombo Stock Exchange, you have to prepare the quarterly financial statements. If it is a listed company, you have to prepare the quarterly financial statements. But every organization prepare their monthly financial statement to get an idea about their position. Otherwise, they won't know what is happening around, and whether every organization they do have budgets, the budget achievement, everything will be assessed using this monthly financial statement. There is no legal requirement as such. Right. If you go to the second session lecture, since we have enough time to start that session also, then we can allocate more time on past papers at the fourth session, financial statement analysis. Now you have a basic background on accounting. You take lending. Lending creates an exposure which is associated with the risk of present and future income and loss of capital or profit. When you lend, as a bank manager, as a credit officer, when you lend, when you take a credit decision, it will create or it will associate risk, not only the present, but also in future to lose your income or lose your capital as well. Therefore, risk management and risk assessment and management are the key skills of any successful lending banking operation. First, you have to assess the risk, then you have to manage the risk, right? In banking industry, you have to take the risk. Otherwise, why don't you, if you don't want to take the risk, you can easily put all the deposit money you have in the treasury bill and treasury bonds. Those are called risk-free investments, right? You have to take the calculated risk. That's why you have to correctly assess the risk and manage the risk. In order to manage the risk, you have to have some corroborative controls incorporate while you are lending, right? The next point, lenders involved with the review and sanctioning process of credit have a primary objective of assessing the risk involved with the view to minimize losses. The point number 2 again emphasize here in the point number 3 also, assessing the risk and minimize the losses, right? You have to make sure you have to have an objective, minimize the losses also. Hence, credit analysis is using accounting techniques to assess the credit worthiness of client is very important, as it will lead to the final decision, the lending process, right? Whatever the final decision will be taken by and large on these analysis. You will take into account various other factors. You will take into account the collateral, you will take into account the other non-financial aspects, qualitative aspects, everything will be taken into account, but the material part of the decision will be based on this accounting analysis, right? We have to speak with the figures, right? With the figures, you have to add other factors as well. I mentioned earlier also, when it comes to credit decision, there are two main aspects that we consider. One is the repayment capacity or the analysis, the credit worthiness of that customer. Then the number 2 is the security or the collateral. If you're satisfied with these two aspects, you can grant a credit. If you have doubt with these two, even though you have a very good collateral, if the customer do not possess the repayment capacity, then there is a question. There are customers, they do have repayment capacity, but they don't have good security. That is also question, right? Therefore, you have to calculate the risk and you have to manage the risk. You may have additional condition, you may have additional aspects to be considered, right? Therefore, the accounting analysis or the analysis of financial statement will play a bigger role in your credit decision. That's why you need to know basic accounting before you make analysis on these credit aspects. This was previously a couple of times discussed. Financial statements includes income statement, including the statement of other comprehensive income. We will discuss in a later part. Then statement of financial position, that is called balance sheet. Then cash flow statement, statement of changes in equity, accounting policies, accounting notes. Accounting policies and accounting notes. Right. I need 1 minute break before start this. Give me 1 minute. Right. Right. Okay. In the lending process, we have different types of business clients. You know better than me. Individuals, then sole proprietorships, partnership, covered under Partnership Ordinance 1890. Then companies registered under Company Act, private limited company, then public limited company. We have associations, clubs, and other entities. If you take individual sole proprietorships and partnerships, these are the basic assessment that you take into account in order to make the repayment capacity of that particular individual or the entity. First, we take the individuals. Credit facilities to individual will normally be considered based on their income, right? Wealth or standing in the society. Tax payment, conduct of bank account will be viewed as evidence, right? Normally, we take the bank account and the salary details in order to assess the repayment capacity. Then the sole proprietorship also, we can consider the credit facilities similar to individuals. Income will be assessed on business profit, business registration, tax payment, conduct of bank account uh, as a proof of business income. Then take the partnership business. Under partnership business comes under the legal framework of Partnership Ordinance 1890, where a partnership can be established in three ways: in a written agreement, by word of mouth, or implied. But here, when it's come to granting loans, there should be a partnership agreement. Partnership agreement is very important document to examine before considering credit facilities. You should have that document, right? Business registration, then tax payments, conduct of bank account will be viewed as evidence of proof of business income. In the event of legal action against partnership, since there is no legal entity for a partnership, action should be filed as joint and several liability. If you take this sole proprietorship and partnership, there should be a proper way of accounting. At least management accounting should be there. And even sole proprietorship and partnership, normally auditing is happening. Even though we talks about this sole proprietorship partnership, there are bigger entity than the companies under this nature. You should encourage those people to have a proper accounting mechanism, proper accounting environment, and get their accounts audited by a qualified auditor, get their accounts prepared by a qualified accountant. And normally these people find it very difficult to liaise with Inland Revenue Department, right? Income tax department, they normally file various assessment against these people, mainly due to their lack of knowledge in accounting. And they also go behind these people, give some money to have a relief. Those kind of things are also happening. But from the points of view of bankers, encourage these people to have a proper set of accounts, proper accounting mechanism, proper system to have accounting, recruit people as accountant, make sure that their transactions are recorded, captured, analyzed, financial statements are prepared. Even the business is the size is somewhat small, they may acquire some people, right? They have enough capacity to acquire people as accountant and put them in track. Otherwise they don't know what will happen to their business. The risk is there, right? The what you can guarantee after you granting a loan to these kind of people, sole proprietorship or partnership, if they don't possess the correct accounting information, there is a huge risk of getting bankrupt of these businesses. If they do have the good accounting information things under them, I'm not referring to sophisticated systems, just collecting the accounting information, transactions, and record in a proper manner. Normally, these people go to find accountants at the end of the accounting period. They take only their bank statements and few other documents and go to accountant and try to prepare accounts by spending some money, right? Encourage these people to have proper at least part-time qualified accountant in their business. encourage them to have those people at the very beginning where the transactions are happening. Emphasize the benefits that they can gain, right? Accounting should not be taken as a matter of filing taxes, as a matter of compulsory requirement to give some financial statements to lenders. It should be part and parcel of the business itself. It gives various benefits to the business organization if there is proper accounts are there. I will quote very good examples when I am dealing with the latter part of the lecture. You can have material benefits when there are proper accountings are happening. It will definitely help both the owners of the business as well as the lending institute like banks, right? Therefore, every time you have to, there is a concept called credit plus, right? Not only the credit, you have to give some credit plus advisors. Encourage these people, especially the people who are from the rural areas. Encourage your people to have some accounting mechanism, or help them to find some good accountant. Uh, Accountants also sometimes they do not want to that much involved in their business. Encourage them also to have the involvement from the very beginning, and there are huge number of benefits are there, right? If I quote a small example, right? Not a business, right? If you go to your home, ask your mother now who's normally taking care of the income and expenses of the house. It's mother. Even though father is there, the mother is the person who cares about the income and expenses of your house, right? If you ask your mother what was the last month's total expenses, to which that we have spent more, whether it is for food, whether it is for medicine. If you take foods, for what items? Sugar, rice, dal, vegetables, milk food, for what items we spend? She doesn't have any clue. But if you ask your mother to write all the expenses and all the incomes she normally do for a month, she do she does that just have that details in the book. If your mother do that for several months, she has very good collection of information. She can compare your expenses on a monthly basis and find out the material variances and reasons for those material variances. We don't have, even though we are talking about, we are as bankers, we are the very reluctant people to manage our financial position in our own, right? Very indisciplined financial people are in the banking industry, right? Even though we are from the outside, we will be looked at like a very disciplined financial people, that we are that working in a bank, but we are very indisciplined. Take your salary, after few days the salary is gone, right? We don't have any discipline at all. When it's come to these bonuses, people are waiting till the bonuses get credited. After that, 1 or 2 days, it will be gone, right? Therefore, the discipline should be there, especially the financial discipline. Similarly, like your mother, right? If she write all the income and expenses, she will have variety of information, right? She can compare, she can contrast the monthly expenses income and find out the reasons. She may have a lot of information to take various decisions. That is a household example. But if you take a business like sole proprietorship partnership, if they don't maintain record, how come they could take the good decision? It is very important that every organization have some kind of accounting. If they don't possess any accounting, that is the end of their business. In short term, they can run, but in long term, there will be definite troubles. Like fraudsters in a business organization. In short term, fraudsters they can survive, but in long term, definitely that will come to light, right? Therefore, very important that you encourage your client, that you encourage your people who come to you to take loans, to have a better accounting mechanism in their own. Encourage that thing, not only for taking loan, you just take the financial statement prepared by somebody else. Don't take that. Encourage them to emphasize the benefits of having good accounting environment in their own to facilitate more benefits, right? Then the final entity is companies. Companies Act registered under Companies Act. That act is number 7 of 2007, effective from 3rd May 2007. Advantage of registering as a company under Company Act: we have a legal entity. Liability of members will be limited to the extent of capital contributed. Then no limitation of number of person contributing to the capital, right? Uh, you can have a variety of people to contribute capital, and you also openly invite all the people using a initial public offering IPO, asking capital from various people. Uh, Now, some salient features, these are not that much important for financial statement analysis, but for the benefit of all and the completeness, I have given these points. Important features of Company Act number 7 of 2007. This is compared with the number 17 of 1982 Company Act. The no concept of par value or no nominal value of share is there. Total issue price is termed as stated capital, right? Now the capital is known as stated capital. Previously there was concept called par value, nominal value. Those have been eliminated from the new Company Act. Then the memorandum of association is no longer required. There were two set of memorandums were there: memorandum of association and memorandum of articles, right? Now the compulsory requirement for to have a memorandum of association is no more there, because under memorandum of association the company's objective was there. The purposes for which the company was established, the objectives was there in the memorandum of association. Now, in those days, under previous Company Acts, a company can only do business which is defined in the memorandum of association. Nowadays, now according to new Company Act, it was withheld. Now any company do any business, right? There is no limitation for a objective of a company. Therefore, the need of memorandum of association is no more required. Uh, no limitation on issued capital, no limitation of business activity of the company, I already mentioned. Articles of association provides the details of the company, also the rules and regulation governing the activities of the company. There is a first schedule called attached to the Companies Act. It give the a model set of articles which may adopt and amend as appropriate for a company. Then these are different types of companies. Company could be incorporated under following categories: limited liability company, unlimited company, limited by guarantee. You can in detail download the Company Act, in detail search for these definitions, but I won't test anything under my section. But there are important other areas under the credit management course where they might test these things. Right. Secretary to the Treasury on behalf of the government has powers to incorporate single shareholder company, only one shareholder company. The Secretary to the Treasury also appoint another person under section 139 as is proxy for every 10% or part thereof. Right. Shares in a company. Section 49 provide issue of different class of shares with different rights. Normally, the main two categories are normal ordinary shares and preference shares. No share will have a nominal or par value. We have already discussed. Shares in a company shall be transferred in the manner provided in the article section 49.5. If there is no restriction on the transfer of shares, it is termed a public company. Such company should use public limited company along with their name, right? Since if there is no restriction of transferring share, we call that company as a public limited company. Normally we call a PLC, right? These are all technical terms under company as won't be tested under my section. If company prohibits offering shares to public, those are called private limited company or private under within bracket PVT and limited along with their name. You have to write that thing. Normally, PLC company can invite, offer their share purchases for the public, but in case of private limited company, they don't have that luxury. Shares may be issued for a cash or consideration as decided by the board. Normally, even though we said consideration as decided by the board, normally shares will be issued only on cash. Or 99% or 100% of the shares will be issued normally on cash. Where shares are issued for consideration other than cash, the board of directors shall determine the cash value of such consideration for the above purposes and take that into account in calculating the stated capital. Right. Now this is important. Accounting records under section 148. Board of directors must ensure that the company correctly record and explain the transactions. Right? There is a responsibility to the board of directors that they ensure correctly record and explain transactions. Right? Then the financial statement should be prepared by a responsible person, namely CFO, Chief Financial Officer, who should certify that the financial statement for compliance with the act. Right? There is a requirement, every financial statement, the main two financial statements, that is income statement and the statement of financial position. Normally, after the statement of financial position, CFO has to sign that these financial statements are in compliance with the Companies Act. Right? That compliance requirement is there. CFO has to sign. Go to your financial statement of your bank and go to the statement of financial position. Make sure that your CFO has signed that financial statement. That is a requirement under Company Act under section 148. Then, in addition to the CFO, signed and dated by two directors on behalf of the board. Right? Under Company Act, they say not only the CFO, two directors. In addition to the CFO, two directors has to sign the financial statements on behalf of the board. Normally, the chairman and the deputy chairman will sign the board on behalf of the board, or either chairman or the managing director will sign the financial statements, because managing director also a director. Then the financial position determined at any given time with the responsible accuracy. Financial statement readily and properly audited by stipulated auditor. Right? When it's come to a bank, Central Bank of Sri Lanka, they will nominate few qualified auditors. But in normal business organization, the qualified auditor will be a chartered accountant. But when it comes to a bank financial statement auditing purpose, every chartered accountant cannot audit the financial statements of a bank. Central Bank every year they publish a list of qualified auditors, right? Now, if you take the bank's financial statement, those are the financial statements very cumbersome and very complex. Because the control environment, the accounting environment, everything is very cumbersome and complex compared to the other entities in the industry. Therefore, the auditing of financial statements of a bank, it will be also a very complex and cumbersome process, which needs a lengthy knowledge and very technical staff knowledge, and you have to have a very good team to audit the bank's financial statement. Therefore, taking into account those aspects, the Central Bank of Sri Lanka, they will issue on a yearly basis the list of qualified auditors. There may be the list may comprise of 10 auditors. The big, large audit firms may be there, right? Therefore, the normal, even though you are a chartered accountant, you cannot audit the financial statement of a bank. Other than the financial statements of a bank, you can audit other financial statements. Then section 159, every company shall prepare financial statement within 6 months of the end of the financial year or within any extended time determined by the register of companies. This is also very important. When you are giving financial facilities to a company, make sure that your company has audited financial statement after the expiry of 6 months if it is a limited liability company. Now, that auditing has to be done by a qualified chartered accountant, right? Say their financial statements end 31st December 2020. You should have the audited financial statement at least by within 6 months in 2021. Before 30th June, you should have a copy of the audited financial statement, because there is a requirement under section 151. Audited financial statement has to be prepared and done audited, and send a copy of the audited financial statement to the company registrar. Otherwise, that is a violation of Companies Act. Therefore, make sure when you are granting facilities to the company, these requirements are also met, right? An annual return must be filled with register of companies along with the audited financial statements, right? Before the expiry of 6 months in the preceding year. For non-compliance, every director in default shall be guilty and liable for a fine of 10,000, 100,000. Every director, right? If you have 12 directors, 1.2 million. Section 5.2 provides similar provision for the group financial statements. Right? This slide is very important. When you are granting facilities to a limited liability company, make sure the audited financial statements are there before the expiry of 6 months in the preceding year for the previous year financial statements. That is a requirement under Companies Act, Section 151. If your clients are not educated about this, make sure that you educate them and prepare the financial statement and get them filled with the annual return with the company registrar. Then this is a bigger company's requirement. If you listed in the if you state as a public company, right? Not the listed. If you have registered as a public company under section 166, board of every public company shall within 6 months after the balance sheet date prepare annual report on the affairs of the company during the accounting period, right? If it is a public company, not only the audited financial statement, you have to prepare a document called, a book called annual report. It should cover these things. What are the things? Annual report should be sent to every shareholder within 15 days prior to the AGM. 15 working days prior to the AGM. Right? Annual return should be, annual report should be reached to the every shareholder within 15 working days. Nowadays, it's very difficult to send the hard copies. Normally, in order to reach this requirement by the public company, if you take a bank, in order to reach this requirement, if you take a bank, there are about 17,000 shareholders, 17,000, 18,000 shareholders, right? You cannot print 17,000 prints of the annual report and send all these to the shareholders. That is not practical. Therefore, normally, the annual report can be in hard form or soft form, right? If you can send the QR code, if you can send the link to the website to the shareholder, that is also enough, right? But the requirement is it should reach to the shareholder within 15 days. Sometimes the people send CDs. That is waste of money. CD normally in these days, normally laptop doesn't have the CD drive, right? Therefore, CD normally when you send, those things will be ultimately end up in the dustbin, right? Therefore, it's better you, for the sake of environment also, not to print the book, not to send the CD, but to send a letter where the QR code is there or link is there to have access in the system. Therefore, there is a requirement, but anything has to reach before 15 working days before the AGM. Right. Under section 168, the content of the annual report is given. These are the few points that you should take into account when you prepare the annual report. The company's nature of the business and type of the business. Then signed by the financial statements of the company for the accounting period and any group financial statements. Signed financial statement should be there. Then auditor's report on financial statement. Normally, once the auditor is audit the financial statement, they will give an opinion, right? Their opinion is written in the report that is called auditor's report, whether the company is in fair presentation and the financial statements are true and fair. They have to express an opinion, right? They may express a qualified opinion or unqualified opinion. Qualified opinion means that is not a good opinion. Unqualified opinion means that is good opinion. There may be some material misstatement. They may express those things also in their opinion. Auditors are free to express their opinion, taking into account the sample that they have audited. The entire they won't audit, no. Then thereafter, any change to the accounting policies, particulars of entries in the interest register, remuneration and other benefits of directors. This is very important. If it is a small amount or big amount, remuneration and other benefits of directors, it has to be mentioned. Now, if you take a bank, the total income statement size is very high. Sometimes 30 billion, 100 billion, the totals are like that. But the director's remuneration might be some millions, right? Even though those are some millions, you have to be very specific and disclose those all information, because there is a requirement under Companies Act. Then depreciation provided in the financial statement separately. Depreciation part separately you have to provide it. Then total amount of donation made by the company, right? Now directors, if they say assume that one company's chairman, he is in he donated some 10 million to his school using the your entity's money. That's why there is a special requirement to separately disclose the donations made by the company, right? The directors cannot decide the donations, therefore very careful in deciding the donation. That's why every public company, there are rules in deciding this donation. It should be the common interest, it should be the public well-being, it should be the corporate social responsibility. Those aspects need to be decided before making a donation, because these are shareholders' money. Therefore, directors cannot donate whatever they want. They will have to face difficulties once the AGM is coming. And in the AGM also, separately, you have to mention these things. Donation made by the company. Then audit fees and non-audit fees. Those are also separately you have to mention. Audit fees and non-audit fees. Even though the size is small, you have to separately mention those audit fees and non-audit fees. Then names of person holding the position as directors, right? You have to give their names, their position, their qualifications, the previously works experience, right? Everything has to be mentioned separately under this requirement. An annual report also will have to be signed by the two directors of the company. Right. For the first day, I will stop at today. This distribution part from next week onward, I will start, because the solvency test we have to in detail discuss. Up to now, if you do have any questions, you can raise now. Make sure that you logged 7 a.m. next week. Next Sunday, it will be 7 a.m., not 8:30. If you do have questions, you can send a text message, or otherwise I will wind up the session. Can we get the past papers from the IBSL, sir? Yes, you can. You can directly call them or visit here with the permission of these officials. You can get the past papers. If you take the format and the structure of the past paper, especially into my section, there won't be any deviation. The structure and the position and everything will be same this year as well. There won't be much deviation from the past year papers. What is meant by interest register? Interest register means if you take shareholders interest and debenture holders interest, there is a separate register. All the changes you have to incorporate it. If there are changes in the shareholders name, new shareholders come, sometimes all shareholders sell their shares, and those changes will have to incorporate. That is called interest register. Similarly, when it comes to debenture also, there is a separate register that will have to be updated. Right. We'll see you next week at 7 a.m. Right? Make sure that you have a copy of the tutorials and presentation uploaded. Thank you very much.